Module 4.5 Putting the TIP value filter into practice. This lesson has two learning objectives. What are the advantages and disadvantages using the TIP value multiple? And how to build a portfolio using the TIP value multiple. If you remember back to Module 4.2, I talked about how billionaires were using a filter as a starting point when identifying the stock picks. From this list, the very smartest people can validate the financial statements and analyze their respective mode so that they, in turn, can pick the best stocks. Warren Buffett is perhaps the finest example, showing more than 20% return on his investment record for more than 5 decades. If you want to apply a similar approach as Warren Buffett, I would recommend that you start your research from a list of the stocks with the lowest TIP value multiple, or clearly any other screener or filter you feel comfortable using. Whatever list you start with, you should, as the next step, implement the teachings you have been taught throughout this course and start searching for strong stocks trading significantly below the intrinsic value. What you'll quickly realize is that you'll find an overlap between the stocks with the highest intrinsic value compared to the price and those with the lowest TIP value multiple. If you are searching for the highest returns in the market, I would recommend a concentrated strategy, only investing in those businesses you truly understand and where you can estimate future cash flows with a reasonable certainty. If this is not the approach for you, I have another suggestion that is a lot more automated and where you can still profit from the outperformance without having the stock picking skill set of billionaires. The strategy is very simple, and you do this by ranking all listed stocks from the cheapest to the most expensive based on the TIP value multiple. You would then buy a basket of the 20 cheapest stocks. So let me elaborate on the different advantages and disadvantages and why this simple strategy works so well. So this is advantage number 1. You will save a lot of time. Call me lazy, but I like the idea of having an automated process in place. Running my business and having sufficient time for family and friends doesn't always leave me time to monitor and analyze potential stock picks as much as I want to. So it works very well for me to include an element of automation. The second advantage is the simplicity of sizing positions in your portfolio. Something I've always struggled with is how much I should invest in each stock. So, say for instance, if I had $10,000 in 10 stocks in my portfolio, should I put $1,000 in each stock, or should I have more in the stocks that I believe most in? The latter always seemed to make more sense to me, but as a result, I always started to doubt whether I was wrong, and if I truly believed that one stock was better than the other, why would I have 10 stocks in the first place? What you can do using the TIP value multiple, and especially if you want to automate the process as much as possible, I suggest that you purchase 20 stocks and put 5% into each stock. Clearly, there is an argument to be made for weighting your position. For instance, why wouldn't you put, say, 7% into the cheapest 10 ranked stocks and then only 3% in each of the stocks ranked from 11 to the 20th place? Or, for instance, put 10% in the very cheapest ranked stock and then gradually assign less of your portfolio according to the rank. I believe both strategies will be profitable for you. However, the counter argument is that when it comes to automating a process, I'm a huge believer in simplicity. This is especially true when you start to rebalance your portfolio, which leads me to the third advantage: rebalancing. The stock that originally composed 5% of your portfolio might drop and now only account for, say, 3%, while another stock that was originally at 5% of your portfolio soared and is now 7%. What to do? You make sure that those stocks that are even more out of favor in the stock market are bought back at an even lower price, while those stocks that are increasing in price as a reflection of the market realizing the potential will be sold at a higher price. In practice, what I suggest is that you rebalance into the cheapest 20 stocks, again back to 5% each, to capture the benefits of rebalancing. Again, simplicity is key here, so don't be too caught up on the stock temporarily taking up a little more or a little less of your portfolio than the 5%. If you rebalance quarterly or even just annually, you should be just fine. Okay, so much for the advantages. What about the disadvantages using an automated strategy? Well, the first one is pretty simple. You'll learn less. For me, stock investing is not only about having an automated system in place that outperforms the market. I also want to improve my investing skills. Clearly, a completely automated strategy doesn't achieve that goal. I've always thought that the best investment you can make is to invest in your own skill set. I like the sustainability of this since it always leaves you with the option to identify the best investment opportunities, and because having an automated strategy in place leaves you very inflexible should you need to change your strategy in the future. The second disadvantage is that you might lose out on an even bigger outperformance. So earlier in Module 4.2, we learned that the TIP value multiple historically outperformed the market more than 5% annually. Historically, very few individuals can sustain such an outperformance, but that is by no means the same as saying that no one can. By following a completely automated process, you would miss out on those superior returns the truly skilled investors like Warren Buffett achieves. This takes me to the next point about the TIP value multiple. Should you build a portfolio around small or large cap companies? Whenever you hear billionaires or fund managers talk about a quantitative approach to screening for stocks, you'll typically only find a match of the stock picks in the large cap screener. How come? Well, consider the example of Warren Buffett. He is currently sitting on $86 billion and a massive stock portfolio of $122 billion. It wouldn't make any sense for him to start investing a few $1,000,000 in the companies found in the small cap filter. Another thing is that even if he decided to do so, it would likely not be possible. The trading volume in small cap stocks would simply not be sufficient for him to buy even a small position without moving the market dramatically. Remember that the price of a stock is only the latest price traded on as little as a single stock. So for Buffett to enter a stock that doesn't trade more than a few thousand units during a day would not be feasible. So what about the rest of us? For us that doesn't have billions of dollars to invest for, should we invest in small or large cap companies? Well, it really depends on you and your strategy. Historically, we can observe that the small cap stocks perform better than the large cap stocks. One drawback for many investors is that if you decide to invest in the smallest stocks, you also have to expect more volatility. Volatility is something few investors like, and even though you can mitigate some of it by investing in 20 or 30 stocks, it will still be a bumpy ride. The discussion of volatility also takes me to another concern. While the typical investor has the advantage of building his portfolio around small companies because he has limited funds, the typical investor also has a huge disadvantage to billionaires and institutions. For US investors, the cheapest commissions discount online brokers offer is around $5 per trade, while international investors typically have to pay between 50 to 150% more. Buying just 20 stocks is already $100 in commissions, even with the cheapest fees. And don't forget that the investor has to rebalance consistently. In other words, if you have $10,000, you will already be paying 1% in fees of your portfolio with implementing the strategy. Depending on the size of your portfolio, I suggest that you buy the cheapest 20 to 30 stocks, depending on your appetite for volatility, and rebalance anywhere from quarterly to annually. If you have less than $20,000, you can slowly transition into the strategy, buying the 5 cheapest stocks each quarter that you don't already own. That way you come in with a rebalancing strategy, lower fees, and the chance of getting your feet wet. Now, why don't more people follow this approach, you might ask? If it's true that you can outperform the market by 5% or even more annually, shouldn't all investors rush into this strategy? Well, it's a very valid question, and I think it comes down to multiple reasons. The first one is that not everyone understands the drivers behind the stock market. Sitting through the course, you will likely realize that the stock market is pretty irrational. Think about why. The prices of stocks are based on how people price in the short term, and in days, months, and sometimes years, it can be highly mispriced. Some stocks are trading above their intrinsic value, and some stocks are trading below their intrinsic value. By using the TIP value filter, you will automatically identify the stocks that are most out of favor compared to the fundamental value. And you'll simply wait for the market to realize the mispricing. As we saw in Module 4.2, we can observe that from 1964 to 2011, the TIP value multiple outperformed the market by 5.3% annually, which is found by backtesting a large set of data. Obviously, this is not something everyone has access to. So even if you do understand the drivers, There are a lot of information out there that are not accessible for everyone, which is another reason why a lot of investors don't follow the strategy. The second thing is that the strategy is hard to implement. As automated as it is, you will still need to buy 20 stocks, and you need to use a filter or you need to do a lot of manual work. Not a lot of people think that is either simple or fun. It's a lot easier to buy the hottest stock you saw on CNBC last night or whatever you just read in the newspaper. You will also consistently need to rebalance, which involves spending a lot of time on your online discount broker site or paying high fees to have someone at your bank do it for you. The third reason is that the strategy won't outperform every year. I never heard about any investment strategy that always outperformed the stock market every single year. And my advice is that if you do hear about such a strategy, you should probably be running for the hills. Mentally, it's almost impossible to stick to a strategy when you have bad months and years and explain not only to yourself but also to your peers why you're following a strategy built on math and not your personal analysis of the firm. Now add to this that the strategy is a bumpy ride with volatility in abundance. The fourth reason is taxes. As you'll have to rebalance your portfolio quite a few times, you'll also have to pay a lot more capital gains tax than you otherwise would. This is definitely something that you should consider whenever you see the outperformance of one valuation metric compared to the other. Typically, it's also assumed that you can rebalance for free, or at least do that quite often. In reality, a lot of these automated strategies are a lot harder to implement because of taxation. To mitigate that, you can invest from a tax-deferred account. You can also use a corporate structure, or you can simply rebalance less frequently. For instance, you can rebalance after 1 year and a day to ensure you won't be paying short-term capital gains tax. None of this is hard, but it's still very time-consuming and just adds another layer to the 3 other reasons just mentioned that might discourage you from implementing the strategy in the first place. So how are you feeling now? Well, I guess you're almost exhausted by the idea of implementing the strategy. Well, think about it like this. Everyone else thinks the same way, and that is exactly why they don't do it and why you'll outperform the market if you decide to do so. Before ending Module 4.5, I would also like to address the question whether you can build your entire stock portfolio up around the TIP value multiple, or if you should only allocate a part of your portfolio to the strategy. I would like to respond to the question like this. If you sleep better at night having more than one strategy in place for your portfolio, I would definitely recommend multiple strategies. Nothing in stock investing is worth giving up sleep. Personally, I don't think the idea of buying cheap stocks and sell them after they reach intrinsic value will ever stop being a bad strategy in the long run. And if you follow the approach with your entire portfolio and hold it in times of negative volatility, I think you'll be more than fine. As you can probably tell, I'm a huge believer in automated processes like described in Module 4, which is also why you'll probably hear me get pretty excited about it. That being said, I'm very humble about my own skills, and I'm aware that I can be wrong. Rather, I have an overall strategy in place, and it consists of 3 sub-strategies. The first one is to analyze stock picks in detail as shown in Module 1 to 3. The second sub-strategy is to pick ETFs that are outlined in another course. And the third strategy is to use the TIP value filter. It's important for me to say that that is what I personally do myself. And I've done it because it makes sense to me after spending years on the Investors Podcast, interviewing the greatest financial minds and hearing what they do. And as you can probably tell, I'm a huge believer in putting your money where your mouth is. So that is my full disclosure. Clearly, it's up to you. If these 3 sub-strategies make sense to you, I definitely think you should pursue them. But even better, I would recommend you to pick and choose of what you think makes sense for you and your temperament and your portfolio by listening to what I and other people have done with theirs. I hope you enjoyed this lesson about how to put the TIP value filter into practice. And I hope you have enjoyed the Intrinsic Value course Preston and I created for you. Below the video, I've added a link to a FAQ to our forum. If you have any feedback or questions for Preston and me, please let us know and we'll get back to you shortly. Thank you for being a part of the TIP community.